In early 2026, when corporate borrowing rates were just skyrocketing and traditional real estate was effectively paralyzed by the cost of capital, one company somehow managed to borrow nearly $700 million. And they got it at a microscopic 4.34%.
Which is wild.
It is absolutely wild. And the way they did it is they didn't just go to a bank. They essentially helped a municipal agency in the city of San Diego buy electricity, then routed the tax-exempt bond proceeds through a Goldman Sachs affiliate, and then used a financial derivative to swap the debt into European currency.
Right. It's brilliant.
Today, we are tearing apart the Q1 earnings call of Realty Income to show you how a seemingly boring landlord, a company that literally calls itself the monthly dividend company, has fundamentally transformed into like a Wall Street shadow bank. Welcome to the deep dive.
It's a truly remarkable evolution, really, because if you have a 401k, an IRA, or any broad market index fund, you almost certainly own a piece of this company.
Oh, yeah.
They operate over 15,500 properties. That's across all 50 U.S. states, the UK, and Europe. They're an absolute S&P 500 titan. But what is truly staggering is not the physical bricks and mortar they own.
Right.
It's the financial architecture they've constructed underneath all those buildings.
Exactly. And that is our mission for you today. We're looking at their Q1 2026 earnings call transcript. Now, typically reading an earnings call transcript it's the ultimate cure for insomnia.
Totally.
But this specific document reads like an aggressive, highly sophisticated playbook for navigating a really chaotic macroeconomic environment. We're going to extract the data forward headline numbers, translate the Wall Street jargon into plain English so you know exactly what is happening in your portfolio. And most importantly, we're going to figure out the underlying mechanics of this $90 billion real estate machine. Okay, let's unpack this. Let's start with the Q1 headline numbers because they really came out swinging, didn't they?
Oh, they absolutely did. And, the numbers require some context to truly appreciate. So in the first quarter of 2026, Realty Income reported an adjusted funds from operations, what the industry called AFFO, of $1.13 per share.
Okay.
That represents a 6.6% growth rate year over year. And alongside that, they deployed an astonishing $2.8 billion in a single quarter at a 7.1% initial cash yield.
Now, I know our listeners follow the markets closely, so we don't need to do like a full real estate 101 here. We know that looking at traditional net income for a massive REIT is essentially useless.
Right, because of the depreciation.
Exactly. The IRS mandates massive depreciation deductions on physical buildings. So on paper, it looks like the company is barely scraping by, even though we know commercial real estate generally appreciates over time. So AFFO is the metric that matters, right? Because it strips out those paper losses and gives us the true unadulterated cash flow of the business.
Precisely. AFFO is the lifeblood. It is the exact pool of cash available to pay that famous monthly dividend, and achieving a 6.6% growth rate on a base of over 15,000 properties in a sluggish 2026 macro environment, no less, is an enormous signal of operational strength.
Yeah, that's huge.
It takes a massive amount of leverage and volume to move the needle on a portfolio of that size.
Which brings us to the guidance bump, because this is where Wall Street really started paying attention. Management didn't just report a strong quarter, they actually raised their full-year expectations.
They did.
They bumped the midpoint of their full-year AFFO per share guidance by 2.5 cents. And they dramatically raised their total investment volume target for the year from $8 billion up to $9.5 billion. Now, on the surface...
It sounds small.
Right. Yeah. Raising your per share guidance by 2.5 cents sounds almost comical. It sounds tiny. If I'm an everyday investor looking at my brokerage app, I might think, is management just taking a victory lap over a couple of pennies?
Well, it only sounds tiny if you ignore the denominator. You have to remember the sheer scale of their equity base. Realty Income has roughly 900 million shares outstanding.
Wow.
So when you increase the cash flow expectation by 2.5 cents across 900 million shares, you're talking about generating an incremental $22.5 million in pure, unexpected free cash flow for the year.
It's the cruise ship analogy. If you are piloting a small speedboat, turning the wheel 10 degrees is nothing.
Right.
But if you're captaining a 100,000-ton cruise ship, adjusting your trajectory by even a fraction of a degree requires a staggering amount of mechanical force, fuel, and momentum.
Yeah.
A tiny numerical increase on a $90 billion platform represents massive underlying operational power.
And that operational power is exactly why they felt confident raising their investment target to $9.5 billion. They didn't just stumble into a good quarter. The underlying story here, the reason they can confidently deploy nearly $10 billion in an environment where other real estate firms are paralyzed, is that they have completely overhauled their capital stack.
Right.
They are no longer heavily reliant on the public stock market to fund their growth.
Let's hover on that point, actually, because if you have a 401k,
Yeah.
you've probably watched your REIT holdings bounce around based entirely on whatever the Fed chairman whispered into a microphone that week.
Oh, yeah. Constantly.
Historically, by law, REITs have to pay out 90% of their taxable income as dividends. You can't hoard cash. So when they want to buy a new billion-dollar portfolio of grocery stores, they have to go out and issue new stock.
Right. And the fundamental flaw in that model is that the public equity markets are notoriously moody. Public market pricing frequently disconnects from the actual on-the-ground operating performance of the physical buildings. Realty Income could have a portfolio that is 99% leased with pristine corporate tenants paying rent on time. But if there's a macroeconomic panic on a Tuesday, their stock price might drop 5%.
And if their stock price drops, their cost of equity skyrockets. Suddenly, issuing new shares becomes way too expensive, and they can't afford to buy new properties profitably. Their entire acquisition pipeline gets held hostage by Wall Street's daily mood swings. So what this management team has done, according to this transcript, is essentially build a bunker to protect their growth from that exact volatility. They spent the bulk of the call detailing their evolution into what they term a private capital ecosystem.
This is the total paradigm shift. They have meticulously engineered 3 distinct, non-overlapping private capital vehicles. These are entirely new, massive pools of institutional money that allow them to continue acquiring assets even if the public equity window just slams shut.
Let's break these down in detail because the mechanics here are fascinating. What's the first vehicle?
So the first is the U.S. Core Plus Fund. This is a $1.7 billion open-ended perpetual life fund. They recently closed the cornerstone capital raise for this, pulling in money primarily from massive institutional players, specifically state, city, and employee pension plans.
Okay, stop right there. Why are massive pension funds handing Realty Income $1.7 billion in a private fund structure instead of just logging onto a brokerage and buying Realty Income stock on the open market? What's the structural advantage?
What's fascinating here is the misalignment of time horizons between public markets and pension obligations. Public stock market investors are overwhelmingly obsessed with short-term metrics. They want day one accretion. If a REIT buys a building, public investors want to see an immediate bump to the earnings per share the very next quarter.
Right, the classic Wall Street demand, what have you done for me today?
Exactly. But pension funds operate in a completely different reality. They have to pay out liabilities to retirees 10, 20, or 30 years from now. They do not care about the next quarter.
Right.
They crave assets that offer lower initial yields but possess aggressive, compounding long-term growth characteristics. Realty Income sees hundreds of properties a year that fit this exact profile premium assets in high-growth corridors, but historically they had to pay on them because public shareholders would penalize them for the low initial yield.
So Realty Income has essentially created a custom menu for a different clientele. They're saying, we have the data and the sourcing capability to find these incredible long-term assets. You have the patient capital, let's buy them together.
Precisely. And the benefit to the public shareholder is direct. Realty Income manages this $1.7 billion fund, generating over $10 million in annualized base management fees. That is highly scalable, capital-light fee income that drops straight to the bottom line for everyday retail investors.
Okay, so Vehicle 1 is patient pension money. What is Vehicle 2?
Vehicle 2 addresses a different operational blind spot, development. It is the GIC partnership. GIC is the sovereign wealth fund of Singapore, representing one of the largest, most sophisticated pools of capital on the planet.
Wow.
Yeah, and this $1.5 billion joint venture is highly targeted toward construction financing and build-to-suit industrial developments in the U.S. and Mexico.
Wait, development. Realty Income is a landlord. They buy stabilized, finished buildings that already have a tenant paying rent, taking on ground-up construction risk, dealing with permitting, supply chain delays, contractor defaults that seems completely contradictory to the steady Eddie dividend profile their investors expect. Where is the execution risk here?
That is the exact friction management is solving for. You're absolutely right. Naked development risk is historically toxic to Realty Income's conservative public balance sheet. But the market dynamics have shifted. Massive e-commerce and logistics clients are demanding custom-built million-square-foot facilities. If Realty Income wants to own those pristine next-generation assets, they have to be involved from the ground up.
So they use the sovereign wealth fund as a shield.
Exactly. By partnering with GIC, Realty Income lays off a massive chunk of the capital requirement and the development risk onto a partner that explicitly wants that higher risk, higher reward profile. Realty Income provides the client relationship and the structural oversight. They earn high yields during the construction phase, and crucially, they secure the right of first refusal to own the stabilized building at the end of the process. It's a proprietary pipeline creator.
That is incredibly clever. They're getting paid to oversee the creation of their own future inventory, using Singapore's money to absorb the shock of any construction delays. Which brings us to Vehicle 3, the Apollo joint venture. When I read this section of the transcript, the financial engineering really took center stage.
This is perhaps the most elegant structure of the three. They raised $1 billion in equity from Apollo Global Management. Now, Apollo is a behemoth in alternative asset management, and they have incredibly deep ties to the massive life insurance and annuity markets.
Right. To contextualize this for the listener, life insurance companies are taking in premiums every single month from millions of policyholders. They sit on mountains of cash, and they have to invest that cash somewhere incredibly safe, so they are guaranteed to have the capital to pay out death benefits decades into the future.
Correct. Insurance capital is fundamentally allergic to volatility. They require ironclad predictability. So Realty Income approached Apollo and did something highly strategic. They carved out a portfolio of roughly 500 single-tenant retail properties that they already own properties sitting right on their balance sheet and dropped them into a new joint venture.
Okay.
Apollo injected $1 billion of fresh equity into this venture. But the genius lies in the specific derivative attached to the deal. The joint venture includes a call option that Realty Income can exercise between years 7 and 15. This option essentially caps the absolute return on Apollo's equity at exactly 6.875%.
Let's slow down and look at the strategic asymmetry here, because you don't need to be a Wall Street derivatives trader to understand why capping an investor's return is a massive win for the company. Commercial real estate leases are not static, right? They have annual rent escalators built into the contracts. A tenant might agree to a 2% rent increase every single year.
Yep.
Over a 15-year period, the compounding growth of those 500 properties is going to push the income generated far above its current baseline. But because Apollo's upside is contractually capped at 6.875%, they don't get to participate in that excess compounding growth.
You've nailed the mechanics. The spread between the growing rental income and Apollo's capped return gets wider and wider every single year, and every dollar of that widening spread flows directly back to Realty Income and its public shareholders.
So Apollo gets the extreme safety and predictability their insurance clients demand. They're thrilled to lock in a guaranteed 6.875% yield for a decade. But Realty Income retained all the long-term compounding upside.
Yes, and they immediately unlocked $1 billion in cash without having to sell a single share of public stock.
Let me throw out an analogy here. I originally thought of this like a car mechanic, but that doesn't quite capture the scale. This feels more like a major Hollywood movie studio financing an indie director.
Oh, I like that.
Right. Imagine Realty Income is the massive studio, say, Warner Bros. They have the distribution network, the marketing machine, the global platform. Instead of making every single movie in-house, they go to an incredibly talented independent director and say, we will fully finance your next film, we'll cover the production costs, and you get a guaranteed, highly lucrative flat fee. But we retain the exclusive global distribution rights forever. The director gets the safety and the guaranteed payout they need to actually make the art, but the studio captures the exponential upside if the movie becomes $1 billion global franchise.
That analogy fits perfectly. Realty Income is monetizing their platform and their distribution network across entirely different pools of capital. They are acting as the global distributor for private funds.
But I have to push back here. Management always spins these things as a win-win. But practically speaking, managing a sovereign wealth fund's construction pipeline in Mexico or running a massive pension fund vehicle is a vastly different core competency than just collecting rent on a local Walgreens. Where is the execution risk? Does this dilute the core business? If I am a retail investor holding this stock, why shouldn't I be worried that management is taking their eye off the ball?
This raises an important question, and it was the primary concern among the institutional analysts dialing into the call. The execution risk lies in the distraction factor. Can a management team built to run a passive REIT successfully operate as an active global asset manager?
Right.
However, management addressed this by pointing directly to the math. They were explicit that they only raise third-party capital if it clearly and directly ties back to growing earnings per share for the public shareholders. They are not doing this to stroke their own egos or build an empire. They're doing it because the traditional REIT model is structurally vulnerable to interest rate cycles. By establishing these vehicles, they ensure that their acquisition engine never stalls. If public equity is too expensive, they simply tap the Apollo money. If development is too risky, they tap GIC. They have built an all-weather vehicle.
Okay, so they have engineered this massive, diversified war chest. They're insulated from Wall Street's tantrums. The obvious next question is, where exactly in the world are they spending all this cash? Which brings us to the actual deal flow.
Yes.
In Q1 alone, management noted they reviewed a staggering $31 billion in potential investment opportunities. That number is almost difficult to comprehend. The sheer manpower, the legal review, the underwriting required to analyze $31 billion worth of real estate in 90 days is mind-boggling.
It is a massive institutional effort. But the more important number is what they actually did with it. Out of that $31 billion, they only closed on 9% of the deals.
9%. That screams extreme discipline. I mean, if you have billions of dollars burning a hole in your pocket, the temptation to just buy everything in sight to show Wall Street you are growing is immense. Throwing 91% of potential deals in the trash proves they are not desperate.
Exactly. When you have multiple diverse pools of capital, you never have to force a bad deal just to deploy cash. You can afford to be ruthlessly selective. And when we look at where that 9% actually landed, it tells a fascinating story about global macroeconomics. The capital was split almost evenly between North America and Europe.
Let's dive deep into Europe, specifically the UK, because management spent a significant amount of time highlighting their European platform as a massive competitive advantage. What is fundamentally broken in the UK real estate market right now that Realty Income is exploiting?
So, to understand the UK opportunity, we have to look back at the bond market volatility over the last couple of years, specifically the crisis involving UK gilts, which are the British equivalent of US Treasury bonds. When the UK faced inflation spikes and political turbulence, the yield on gilts spiked aggressively.
Right, and in real estate, the risk-free rate is gravity. If an investor can get a guaranteed risk-free 5% yield from the British government, they're going to demand a 7 or 8% yield to take on the operational risk of buying a commercial building.
Precisely. As bond yields skyrocketed, property values across the UK faced severe downward pressure. Cap rates, the required yield on an asset, expanded rapidly. This created a massive dislocation. The market essentially froze for highly leveraged private buyers who suddenly couldn't make the math work with expensive debt. It became an absolute buyer's market for anyone who actually had cash.
Makes sense.
Furthermore, the European commercial real estate market is structurally different from the US. The US market is incredibly crowded. If a pristine, single-tenant FedEx facility goes up for sale in Ohio, there are dozens of mega REITs, private equity firms, and institutional buyers in a bidding war. The European market, however, is highly fragmented.
So Realty Income, armed with billions in fresh capital, can swoop into a fragmented, distressed market and execute massive portfolio-sized deals without facing the intense bidding wars they see back home. They're acting as a consolidator in a fractured environment.
Exactly. Meanwhile, back in North America, they noted the transaction market remains highly active but heavily competitive for those smaller one-off assets. So in the US, they're leveraging their scale, looking for complex, structured investments where their massive balance sheet provides a distinct advantage over smaller regional players.
And then there is the newest frontier they discussed, Mexico. They've officially entered Mexico via that GIC partnership we broke down earlier. Now, building industrial facilities in Mexico isn't just a random geographical expansion. It is a highly calculated macro-thematic play.
Yes, it's a direct play on nearshoring. Over the past 5 years, massive geopolitical tensions and supply chain disruptions have terrified global manufacturers. Companies are aggressively migrating their supply chains away from Asia, seeking to manufacture and store goods as close to the U.S. consumer as possible. The border region of Mexico is seeing explosive industrial demand.
But the obvious risk there is currency fluctuation. If you're collecting rent in Mexican pesos and the peso collapses against the dollar, Your earnings get wiped out regardless of how good the building is.
Which is why management was incredibly explicit about the risk mitigation here. They have mandated that all leases in these Mexican developments are strictly dollar denominated. Realty Income gets paid in US dollars, completely neutralizing the localized currency risk.
So what does this all mean for their sourcing strategy? There was one statistic buried in the transcript that I think reveals the ultimate truth about how this company operates today. They stated that a staggering 94% of the opportunities they closed this quarter were relationship-driven.
Yep.
If 94% of your multi-billion-dollar deal flow is relationship-driven, you are not browsing the open market. You are not waiting for a commercial broker to call you with a listing. You have effectively created a shadow market.
That is the perfect way to describe it. Because they own 15,500 properties, they already possess direct board-level relationships with the biggest retailers, logistics companies, and developers on Earth. They bypass the open market entirely. They negotiate sale-leasebacks directly with corporate suites before a property ever hits the public radar. Bypassing the open market means bypassing open market competition, which protects their yields.
It is the ultimate VIP room of global real estate. What blew my mind in this transcript is that buying traditional physical real estate isn't even the only way they are deploying capital anymore. To truly capture value in this high interest rate environment, they are stepping outside the traditional role of a landlord and increasingly playing the role of a Wall Street bank.
This is perhaps the most significant strategic pivot discussed on the call. During Q1, Realty Income deployed a full $1 billion into credit and structured investments. They are literally issuing hundreds of millions of dollars in loans.
The transcript gave us two very specific examples of this. First, they issued a $375 million loan alongside a sovereign capital investment firm, backed by a portfolio of high-quality logistics assets set to an e-commerce giant. Second, they issued a $190 million loan to support the development of a massive data center campus in Virginia, pre-leased to an investment-grade hyperscale tenant. Think Amazon Web Services, Microsoft Azure, or Google Cloud. Now, if I'm an investor, I might be confused. I bought stock in a real estate company, not a commercial bank. Why are they taking on the risk of lending hundreds of millions of dollars?
Well, to be clear, they are not pivoting into a permanent banking model. They aren't issuing standard 30-year commercial mortgages and holding them to maturity for a tiny spread. These are highly specific, short-duration loans tied directly to the construction or stabilization phase of an asset. The industry term for this strategy is loan to own.
Right, let's go back to that movie studio analogy. Or actually, let's use a sports car analogy for this one. It's like paying someone to build a custom sports car for you, while earning high interest on the money you lent them to buy the parts, just so you can buy the car from them later.
That's a great way to put it.
So if a top-tier private developer wants to build a $500 million data center campus in Virginia, they need a massive influx of capital to break ground. Traditional banks are pulling back. So Realty Income steps in and says, we will lend you the $190 million. We'll charge you a very attractive high-yield interest rate during the construction phase to compensate us for the risk. But the contractual catch is that we retain a right of first offer or a direct path to acquire the physical building once it is fully built, stabilized, and generating cash.
Exactly. It's a dual-pronged strategy. On the front end, they earn outsized yields on their capital during the risky development phase. On the back end, they lock in an exclusive pipeline to acquire premium, stabilized assets that they want to hold for decades.
But let's push on this specific asset class here. Realty Income is historically famous for retail pharmacies, dollar stores, big box groceries. Why are they suddenly so heavily focused on a data center campus in Virginia? A data center is incredibly complex. It's not just a concrete box with a roof. It requires massive power grids, advanced cooling systems, redundant fiber optic connectivity. Why take that leap?
If we connect this to the bigger picture, it is all about future-proofing the portfolio and managing residual risk. The macroeconomic demand for data centers, driven primarily by the explosion of cloud computing and generative artificial intelligence, is virtually insatiable. The rental growth rates in the data center space far exceed traditional retail. However, as you mentioned, they are highly complex. Management explicitly noted that Virginia is the epicenter of the global data center industry. It has the legacy infrastructure, the massive power grid availability, and the fiber networks that the tech giants mandate. By lending to the absolute best-in-class private developers in the epicenter of the industry, Realty Income gains exposure to the most lucrative real estate sector of the next decade without taking on the operational nightmare of trying to build a data center themselves.
They're essentially paying the experts to build their future portfolio, and making a profit on the financing along the way. It's a brilliant way to plant seeds in high-growth sectors. But while they are busy building for the future with AI data centers and nearshoring logistics hubs, they still have to manage the reality of a massive legacy portfolio. They have to clean up the ghosts of the past. Which brings us to a surprisingly lucrative yet totally counterintuitive housekeeping strategy discussed in the transcript.
You're referring to the lease termination income.
Yes. I found this specific data point absolutely fascinating. In just the first quarter, Realty Income generated $40.2 million in lease termination income. This is cash collected directly from tenants who paid penalties to break their leases and abandon their buildings early. And management was so confident in this trend that they raised their full-year forecast for this specific line item to between $45 and $50 million. Now, if you have any common sense, hearing that dozens of your tenants are paying millions of dollars to flee your buildings sounds like a massive flashing red siren. It implies your tenants are failing or your locations are dying. Yet, management presented this $40 million as a massive strategic victory. How does tens of millions in broken leases translate to a win?
To understand the underlying logic here, you have to look at how Realty Income has expanded over the last 5 years. They haven't just bought individual properties. They have executed massive multi-billion-dollar corporate mergers. They acquired Verit. They acquired Spirit Realty. When you swallow another company's entire portfolio whole, you are buying the good, the bad, and the ugly.
Yeah.
You inevitably inherit properties in suboptimal locations or leases tied to businesses that you fundamentally do not believe in long-term.
Right. You buy a 1,000-property portfolio, and 50 of those assets are obsolete strip malls or dying retail concepts.
Exactly. The traditional old-school way a landlord handles that is passive. You sit on your hands, collect the mediocre rent, wait 7 years for the lease to finally expire, and then try to figure out what to do with an empty building. Realty Income operates with a radically different asset management philosophy. They utilize a proprietary predictive analytics division.
Let's pull the curtain back on that. When they say predictive analytics, what is the algorithm actually crunching?
It is an incredibly deep data dive. They are synthesizing mobile phone ping data to track localized foot traffic trends. They are layering in local demographic shifts, changes in municipal zoning laws, and the real-time credit default swap pricing of the corporate tenant. If the algorithm flags a specific location and predicts this tenant's revenue at this specific corner is going to decline by 20% over the next 36 months, leading to a high probability of default. Realty Income doesn't wait for the storm to hit.
Wow.
They proactively approach the struggling tenant and say, we can see the writing on the wall, and we know you aren't thrilled with this location either. Let's make a deal. If you pay us a lump sum breakup fee today, we will let you out of the contract early.
Here's where it gets really interesting. They take that $40 million in cash up front, but they don't just leave the buildings empty. The transcript explicitly noted that their overall recapture rate when they release these specific properties to new tenants is 103%.
That 103% is the magic number. It means that when they surgically remove a weak legacy tenant and bring in a stronger, better capitalized tenant, the new tenant is actually paying 3% more in base rent than the old one was.
So basically, they have engineered a scenario where their tenants are paying them tens of millions of dollars for the sheer privilege of letting Realty Income raise the rent on the next guy. That is an almost insulting level of leverage.
It really is.
It's a brilliant double dip. They get a massive cash payout to terminate the lease. They get the physical asset back immediately. They lease it to a stronger tenant at a higher rate. And then they take that $40 million in breakup fees and recycle it into buying those new data centers in Virginia. It is the ultimate portfolio optimization engine.
It's capital recycling at its finest. However, it is important to note that predictive analytics isn't a flawless crystal ball, and the institutional analysts on the call certainly press management on some specific portfolio risks that aren't easily solved by a breakup fee. For example, they heavily scrutinized the theater sector.
Right, the movie theater business. The transcript noted that rental revenue from their theater properties actually dropped 10% year over year. In a portfolio known for stability, a 10% drop in any sector is glaring. What is the real story there?
The 10% decline is a complex mix of three factors. First, it is the lingering operational aftermath of the Regal Cinemas bankruptcy. Realty Income had to proactively restructure several leases to ensure the tenant could emerge from bankruptcy and keep the doors open. Second, there was a technical accounting shift from a cash to an accrual basis for some of these assets.
Okay, and the third?
The third factor is the most structurally significant. They are transitioning toward percentage rent structures with these operators. Instead of demanding a high fixed base rent that might crush the theater operator during a slow month, Realty Income takes a lower guaranteed base rent, but negotiates a contractual cut of the actual box office revenue.
Which fundamentally shifts Realty Income from being a passive landlord to being a direct equity participant in the success of the global box office. If the movies bomb, Realty Income's rent check shrinks.
Exactly. Management noted that the global box office is in a recovery phase, trending toward $9.5 billion this year, but it's still significantly below the $11 billion peak we saw prior to 2020. So theaters remain a volatile sector that they are forced to monitor very closely.
But on the complete opposite end of the entertainment spectrum, management sounded incredibly bullish, almost defiant about their gaming assets.
Yes, the casino portfolio. Realty Income owns the real estate under iconic, irreplaceable properties like the Bellagio and City Center in Las Vegas and the Wynn in Boston. Management drew a very sharp contrast here. They view high-end gaming as a highly resilient asset class because they strictly partner with absolute top-tier operators who possess massive, sustainable EBITDA.
Right, which is the core measure of cash operating profit.
Exactly. They aren't buying regional second-tier riverboat casinos that struggle during a mild recession. They own the literal centerpieces of the Las Vegas Strip.
It really highlights the granularity of their underwriting. They aren't just blindly acquiring concrete structures. They're underwriting the fundamental business model of the tenant inside the structure, whether it's an e-commerce logistics giant, a struggling movie theater chain, or a global hospitality titan. But here's the reality check. Managing those physical properties and executing those lease negotiations is only half the battle. To make the math work on a $9.5 billion annual acquisition target, you need cheap debt.
You absolutely do.
You absolutely have to be able to borrow money at interest rates significantly lower than the yield you are generating from the buildings. And that brings us to what I consider the absolute climax of this entire earnings call. Segment 6, the financial engineering masterclass.
If you want to understand the true, almost insurmountable competitive advantage of Realty Income, this is the transaction to study. The chief financial officer walked the analysts through a $694 million term loan they orchestrated. And the sheer complexity of this transaction is staggering.
It broke my brain a little bit the first time I read it. We need to walk through this very slowly because it involves a municipal power agency in San Diego, the investment bank Goldman Sachs, and a cross-currency swap into euros. How on earth do these three things combine to fund a real estate company?
Let's unpack the mechanics step by step. The transaction relies on a mechanism known as a municipal prepay structure. It starts with San Diego Community Power, which is a public municipal agency responsible for procuring energy for the residents of San Diego.
Okay, I'm with you.
So to lock in cheap energy supplies for the next decade, this municipal agency wants to buy massive amounts of electricity up front. To fund that massive upfront purchase, they issue municipal bonds. Because they are a public agency, these bonds are generally tax exempt for the investors who buy them. Because the investors don't have to pay federal taxes on the interest, they are willing to accept a much, much lower interest rate than they would demand from a regular corporation.
Okay, I follow that. The city agency raises hundreds of millions of dollars incredibly cheaply because of the tax-exempt status. But what does a city buying electricity have to do with Realty Income? How does the cash jump from the city to the REIT?
This is where the Wall Street architecture comes in. The municipal agency doesn't just hand the cash directly to a power plant. They route it through a financial intermediary, in this case, an affiliate of Goldman Sachs, who essentially guarantees the delivery of the energy over time. So now, Goldman Sachs is sitting on hundreds of millions of dollars in cheap, tax-exempt municipal proceeds.
Oh, I see where this is going.
Goldman Sachs needs to invest that massive lump sum somewhere incredibly safe to generate the yield required to back the transaction over the next 10 years. They cannot take risks with it. So through this established structural mechanism, Goldman effectively loans a massive portion of those proceeds, $694 million to Realty Income. Yeah, and in return for receiving the $694 million lump sum, Realty Income, leveraging its pristine A-rated corporate balance sheet, agrees to pay a fixed annual interest rate of 4.91% for 10 years.
Okay, let's pause and appreciate that number. In early 2026, when the 10-year Treasury is elevated and standard corporate debt is incredibly expensive, securing a 10-year unsecured corporate loan for nearly $700 million at a fixed rate of just 4.91% is already a phenomenal victory. It's regulatory arbitrage. But the transcript shows they didn't stop there. They pushed the engineering one step further.
No, they didn't stop. They took $500 million of that specific loan tranche and immediately executed a financial derivative known as a cross-currency swap into euros.
For the retail investor listening to you right now who isn't trading Forex in their spare time, what exactly is the wizardry happening in a cross-currency swap?
It comes down to central bank policy. The interest rates set by the European Central Bank have historically been, and continue to be, lower than the interest rates set by the U.S. Federal Reserve. Therefore, borrowing money in European currency is fundamentally cheaper than borrowing in U.S. dollars.
Right.
Now, normally, a U.S. company can't just borrow in euros without taking on massive currency risk. If the dollar to euro exchange rate swings violently, it could bankrupt them when they try to pay the loan back. But because Realty Income actually owns billions of dollars of physical real estate across the UK and Europe, they have euro-denominated rental income flowing into their bank accounts every single month. They naturally have the foreign currency to service the debt.
Right.
Therefore, they can safely use a financial derivative to effectively swap their US dollar debt obligation into a euro debt obligation.
They're essentially trading their expensive U.S. mortgage for a significantly cheaper European mortgage, using their global tenant base to naturally hedge the currency risk.
Exactly. And because the European interest rates are fundamentally lower, that swap dragged the effective interest rate on that $500 million tranche down massively. When you blend the entire $694 million transaction together, their final all-in cost of debt was locked in at an incredibly low 4.34%.
That is just phenomenal. So let's summarize this madness. They helped the city of San Diego buy power, which allowed them to access tax-exempt bond proceeds via Goldman Sachs, give them a massive discount on the borrowing rate. Then, they used their European rent checks to swap the currency, driving the rate down even further to 4.34%.
It's brilliant.
If we look back to the very first segment of this deep dive, the headline numbers stated that they're acquiring new properties at a 7.1% initial cash yield. If you're generating a 7.1% return on the buildings you buy, and you are borrowing the money to buy them at 4.34%, that spread is cavernous. That is pure, unadulterated profit margin that drops straight to the bottom line.
If we connect this to the bigger picture, this specific transaction illuminates why scale is the ultimate moat in modern commercial real estate. Imagine you are a highly competent mid-sized private real estate firm. You find a phenomenal $50 million shopping center that you want to buy. You go to your regional bank for a commercial mortgage, and they quote you an interest rate of 6.5 or 7%. If the property only yields 7%, your profit margin is zero. The deal dies on the vine. But Realty Income can evaluate that exact same shopping center, buy it, and finance it at 4.34% using municipal energy bonds swapped into euros. They generate massive free cash flow on the exact same physical building because their cost of capital is mathematically superior.
Right.
Their true competitive advantage is no longer just the real estate they own, it's their unrivaled global access to highly creative, ultra-low-cost capital. It provides them with an almost unfair advantage over private buyers.
It is a completely different game, played on an entirely different level of the financial stratosphere. Which really brings us to the bottom line of this entire deep dive. I want to speak directly to you, the listener, for a moment. If you hold REITs in your 401k, or if you are looking at Realty Income as a potential cornerstone for your dividend portfolio, the lesson from this Q1 2026 transcript is profound. Modern commercial real estate, when operated at this colossal $90 billion scale, is no longer just about collecting rent checks, paving parking lots, and fixing leaky roofs.
Exactly.
It is about operating as a highly sophisticated, globally integrated capital allocator. From engineering bespoke private funds to capture billions in pension and insurance capital, to acting as a high-yield mezzanine lender for the artificial intelligence data center boom, to executing regulatory arbitrage with municipal electricity bonds to shave basis points off their interest expense. It is a masterclass in modern financial architecture.
It truly is. And it serves as a powerful reminder that while the company's trademark is the monthly dividend company, which, sounds very quaint, very simple, and very safe, the engine operating underneath that trademark is a razor-sharp, highly diversified global financial platform It is meticulously designed to isolate and protect your dividend regardless of what the broader macroeconomic environment throws at it.
Which leaves me with one final provocative thought for you to mull over as you review your portfolio. We talk extensively today about management's realization that public stock market pricing is deeply flawed, often getting wildly disconnected from the actual underlying operating performance of the physical buildings. The stock market is moody, panic-driven, and short-sighted. Real estate is steady, long-term, and compounding. If mega REITs like Realty Income continue to successfully construct these massive, multi-billion-dollar private capital ecosystems, partnering directly with sovereign wealth funds, pension plans, and massive insurance conglomerates, will the future of mega-cap commercial real estate eventually migrate away from the public stock exchanges entirely? If private institutional capital is more patient, vastly more abundant, and structurally less volatile than public equity, could the public REIT of the future eventually evolve into nothing more than a management shell or a holding company for a sprawling, invisible empire of private funds? Think back to our opening premise. When you drive past a massive logistics warehouse or a pristine retail center, you think it's just a building. But as we've seen today, that building is just the physical anchor for an invisible, fiercely complex global web of financial engineering. We want to thank you so much for joining us on this deep dive. Keep questioning the numbers, keep looking under the hood of your portfolio, and we will see you on the next one.